Hey guys, what's going on? Today I want to talk about VOO and pretty much what it is and why so many people passively invest into this ETF every week, every month, and every year. So, if you're not familiar with what Vanguard is a brokerage that is not privately owned. It's instead rather owned by each of its customers. So, their fees are much less than other brokerages out there. And the reason people like their ETFs, like I just mentioned, because the fees are very limited. I think the expense ratio is like point zero 0.03. So that means you're going to pay $3 per $10,000 invested. You know, that is very competitive. Many brokers are trying to compete with Vanguard now, and they're lowering their expense ratios down to compete with them, but 0.03 is pretty much the bottom. I mean, Fidelity has some that are actually there's no expense fees at all. But other than that, I mean, 0.03 is probably going to be one of, if not the lowest S&P 500 ETFs out there that you can invest into. And another reason people like this ETF so much is that it's not actively managed. It actually just tracks the S&P 500 index. It's a passively managed ETF. Vanguard is not actively trading it. They just pick, 500 of the biggest large and mid cap stocks in the United States. And historically, it's done pretty well. There's obviously no guarantees investing into the stock market. It's done well the past 20 years, but it's hard to say what it's going to do the next 20. But there are a lot of people that believe that it's going to do really well, and you're going to get exceptional returns. And people often argue that investing into passively managed ETFs, low cost, are one of the best ways to invest in the stock market, because the amount of time you spend on analyzing individual stocks and just time in general is very minimal compared to other actively managed funds, or if you're just actively picking individual stocks. So, however, with that being said, I think a combination of the two makes sense. Do I think everyone should pick individual stocks? Absolutely not. Do I think there's more upside potential? There can be, but you also can underperform the market. So I think the majority of people, should consider investing into an index fund or an ETF that tracks an index. So we're living in a world today where it has never been easier to do just that. It doesn't matter what broker you're with. Some brokers out there still don't allow fractional share investing, but there's a lot that do. Robinhood does, Fidelity does, M1 Finance does, and I'm sure there's many more that do or will shortly in the future begin to implement that feature. I know Vanguard just came out with the ability to fractional share into their ETFs. So if you have a brokerage account with them and you want to invest $100 into VOO, you can do that. You can't invest into like other ETFs, but any type of Vanguard product that's an ETF, you can fractional share invest into it. But yeah, so if you're looking for a way to just set it and forget it, invest into the stock market, get the average stock market return, 7 to 8% per year. Some years might be more, some years might be less. But the longer you're in the investment, the more that you can expect to get to that average 7 to 8% per year. Obviously this year it's almost down 20%, but the past previous years it's been really well. So it's going to go up and down, but over time, I'm a believer that the stock market's going to go up. I'm bullish on the United States, and just historically speaking, when looking at back testing, portfolios 20, 30 years, the stock market tends to go up more than it goes down. Who knows that that's always going to be the case, but I'm still bullish, long term. And especially if you have a long term, like a long time horizon, there's no reason not to be invested and, be thinking down the road 10, 20 years. Because oftentimes, more than not, you're going to be kicking yourself for not buying more. You're going to look back one day and be like, man, I wish I would have bought more at these current levels. But yeah, don't invest more than you can afford to lose. Investing into the stock market should only be with funds that you're fine with not being liquid. Not liquid on. Meaning, if you would have invested in January of this year, you would have been buying shares around 430, 437, 436. And currently it's at 361. So it wouldn't make sense to buy then and then sell now, because you'd be down $70. So any money you put into the stock market, just understand that stocks can go down and you can be in a illiquid position. And that's fine if you're investing with money that's not needed for an emergency fund or for anything in the short term. So do keep that in mind. Don't invest money that you need next week or that you're saving for a house or another big purchase. Invest with money that you're fine with not using for a year, 2 years, maybe even 3 years. Just because clearly what we've seen this year is if you would have invested in January, you'd be down almost 20% on your money. So it would make no sense to buy then and then sell. You'd be losing 20% of your money, and nobody, wants to do that. But yeah, guys, that's it for this video. I just wanted to talk about, one of the best ways to invest into the stock market is, passively investing into index funds. Vanguard is a great option. Definitely do your own research though. There's tons of different firms out there that have cheap options in today's market. Vanguard is just one of the most popular ones out there. Now, obviously, if you want to sell options like covered calls or anything like that, VOO is not a real liquid ETF. So there's average volume of 3.79, right at, versus like an SPY that has an average volume of 79 million. But, the expense ratio is higher. So if you're not going to sell covered calls, it might not make sense to invest into a more expensive ETF that tracks the same index. But yeah, so keep those things in mind. But yeah, that's it for the video. I just wanted to quickly talk about, investing doesn't have to be hard. Oftentimes, the more boring it is, the more efficient it can be. You're not actively buying, selling. You're just buying one time and you're holding. And you're going to go learn how to make more money outside of the stock market that you can then deploy into your investments. So that's it for the video. Thanks for sticking around. If you guys are still here, feel free to like and subscribe down below. Help the channel out. Help us grow and to get to 1,000 subscribers. But yeah, if you guys have any other video suggestions, feel free to leave them down below. And as always, this isn't financial advice. Do your own research. But yeah, thanks for watching, guys. Take care.